Dhirendra Tiwari, Head of Research with Antique Institutional Equities, joins us live now. Dhirendra, good morning. Thank you for joining us. Are you a bit worried about the current setup? Crude is up, rupee is down, flows have dried up, and in the near term there are no triggers which perhaps would generate upside momentum for Indian markets.
Yeah, all of what you said is right. And important point that we are witnessing today is that there are very few catalysts right now to trigger up the markets. Fundamentally, things are okay, but not very exciting. But the thing is that what we look at from here on, possibly things will start improving maybe 2 quarters, 3 quarters down the line. What we have seen in recent times, as you know, is the economy going through probably the lowest in past 10-12 years. IIP is down to 2%, and so and when we do ground assessment, we do not really hear a lot of positive things from the corporates. So things are bad fundamentally, but that is the thing which is known. What is not known is probably what can be the upside from here on. And our view is neutral in the sense that we are looking at moderate gains as far as markets are concerned this year, not very exciting gains. But I think there is a reason not to be too pessimistic about the whole thing, because what we have seen in past several occasions that when pessimism is at the highest, probably there are opportunities to be made. So I would see the market in this fashion, that look at market in a bottom-up approach. You find good value among many sectors and invest into those stocks and wait for the recovery to happen. That is, I think, the best strategy to look at in next 6 to 9 months, rather than looking at the index per se and start worrying about that.
Fair point, Dhiren. Dhiren, news coming in this morning that wholesale may be looking to merge ACC and Ambuja. What would it mean for the shareholders?
We'll have to wait for the details, but I think cement sector as a whole has been good, both from the earnings point of view and corporate action point of view. It can definitely give a boost to many companies in the sector, large and small as well. So I think this is a sector which is open for a lot of opportunities in next 1 year, and I'm sure that investors will make decent returns in this particular space.
Dhirendra, as a house, you are bullish on energy stocks, especially oil marketing stocks. Now, policy reforms have kicked in. Diesel prices have been deregulated. Gas prices are poised to go higher. These are path-breaking reforms. But despite 2 mega path-breaking reforms, energy stocks are still languishing.
Not really. If one looks at relatively longer term track record, ONGC is reasonably up in last 6-7 months. So I would say that if you look at 1-2 months performance, you are right. But looking at 9 months or 10 months kind of stock price of ONGC, it is definitely has given decent returns to the shareholders. As far as oil marketing companies are concerned, yes, I mean the biggest worry for them is the INR, which is a big catalyst for these companies. So I think while you are absolutely right that diesel price hike as well as gas price increase is probably the best sort of reform that we have seen in last 10 years, I would say. It is definitely going to help these companies. It will definitely help the economy. I would say that if we are in a position to see some clarity as far as the movement of the currency is concerned, there is good amount of money to be made in stocks like BPCL over a period of next few quarters. So I am still positive on that particular space, especially ONGC and BPCL, despite the recent correction, particularly in BPCL. The joker will be, of course, the rupee.
Right, let's look at GlaxoSmithKline Consumer. On Tuesday, market conditions were pretty ordinary, but Glaxo Consumer added about 300 rupees, which means in this week itself, only 2 days, GlaxoSmithKline Consumer has appreciated by about 500 rupees. There you go. This week appreciation, we're looking at a 5-day change here. It's about 10%. If you only look at the 2-day appreciation, which is Monday and Tuesday, I think it's a big appreciation. Right. Dhirendra, what is the deal with the GlaxoSmithKline consumer? Valuations are not expensive, but they are wildly expensive, and despite rich and frothy valuations, this stock is just going up.
Frankly, we don't cover the stock, but as a broad theme, I would say that MNC stocks have seen significant re-rating, not only Glaxo, but if you look at across sectors, there have been significant rallies in MNC stocks, primarily because of hopes on corporate action. So I think this is a category which looks promising only from that perspective. Specifically for pharma and FMCG MNCs, the additional advantage is that this is an area where investors find some refuge, in the sense that you still see corporate earnings. So I think valuations have never been the only reason for re-rating or de-rating of the stocks. If you see visibility of earnings and the lack of opportunities in many other sectors, I mean, market will continue to reward such stocks. So I mean, this is the only statement I can make on that. But I think generally speaking, MNCs will see valuations trading higher, primarily because visibility of earnings, and secondly, definite corporate action over next 1-2 years of time.
Then what's your sense in terms of what IT may do this quarter? I mean, of course, there is the rupee factor, but then sentimentally, you've also got the immigration bill, which is impacting the IT stocks.
IT outlook may not be very encouraging in this quarter. Probably in quarter-on-quarter, we may see 1-2% kind of revenue growth across large caps, barring maybe TCS. So I think it is, in our opinion, unlikely to be a very exciting quarter. Though situation may change if US economy continues to do slightly better than what it is expected now. But this quarter, our broad expectation is that 1-2% kind of revenue growth Q-on-Q. Maybe margins can be slightly better than expected. But earnings, yes, I mean, it is unlikely to be something which is going to be meaningfully different from what the consensus is right now. So it will be kind of a non-event kind of quarter for IT stocks, in our opinion.
Dhirendra, at a time when markets are not rotating and money is only moving in and out of 3 large sectors, FMCG, pharma and IT, where are you picking up your spots?
Pharma and FMCG are definitely seeing a lot of investors' interest, primarily because of the reason we discussed earlier. In our opinion, FMCG looks expensive, so we don't have any buy in that particular space except for ITC, which I think is a consumer monopoly, will continue to attract a lot of interest. Barring that, we don't see real value in that, and probably it is a matter of time when the valuation will start correcting. Pharmaceuticals, yes, earnings growth is intact and probably will continue to do so with rupee being weaker. And valuations are also not that demanding if you look at the sector with respect to FMCG. So pharma continues to be a preferred sector with a few names in that particular space. Barring that, we have, I think the best way to look will be to find niches and opportunities in many of these sectors. For example, we like four-wheelers in the auto, we like few industrials, we like a few energy stocks. We would be interested in some of the front consumer-facing stocks. So I think, in my opinion, 2013 will not be a sectoral theme-based year. It will be basically stock-picking year with a lot of interesting opportunities from each of these sectors. So I would say if one looks at pure sectors, pharmaceuticals, private sector bank, NBFCs, autos, these are the sectors we will be more interested in terms of recommending.
Dhirendra, you just mentioned autos. Given the way how the monthly sales data has trickled in, and largely it's been a mixed bag of sorts, what would be your top contenders when it comes for the auto pack?
See, auto, I would say that the latent demand in India is very, very strong. I mean, this is the opinion we continue to hold. In near term, because of high interest rates, sentiments being slightly on the lower side, we are seeing some sort of moderation in the demand per se. But I think in the near term, the story in auto will be margin story, particularly for Maruti and Tata Motors, especially on the overseas business. Going forward, in my opinion, post FY13, FY14 can again see a reasonable surge in demand coming back with some sort of interest comfort to consumers, and also with economic activity picking up. So I think if one looks at the space, Maruti is our top buy, primarily because we don't see real volume pickup in the current year, but we see earnings growth with margins going up. And next year we are hoping that possibly the demand will also pick up, and say about 13-14 times it is not extremely demanding stock to hold on. So I think in this environment this is a reasonably safe bet in auto space. Two-wheelers we are not that excited, but I think there may be opportunities emerging in next few months with correction in the stock prices.
Final question. Which are some of the key, monitorables which will convince you that it is time to jump out of consumer and pharma stocks and it is time to revisit infra and industrials? As of now, markets are betting that, Indian economy will recover, capex cycle will start, but there is very little evidence of that. So what are you monitoring which will convince you to switch sides or switch sectors?
See, if you look at infra and industrial, I would put it in this way. There are three broad segments within that. One is pure industrials, which is basically machinery. The second is construction stock. The third is the asset owners. So you have to look each of these three segments separately. In my opinion, industrials are already at stock price evaluation, which is worth investing with slightly longer term view. Because if you look at many of these stocks, whether it is Larsen or BHEL or Crompton Greaves or Voltas, they are probably trading at historical low valuations. So these are quality companies with very strong business profiles. So whenever there is a recovery, these are the first ones to bounce. It doesn't mean that we have buy on all of them. We have buy on L&T and Crompton within the space. But the point I'm trying to convey is that industrial stocks are at levels where there is very little to lose. To gain will take some time. Construction still some time away. We will probably monitor what is happening as far as interest rates are concerned, because that is the biggest worry for some of the construction stocks. Third is the asset owners. The same situation prevails there. We will have to monitor execution on key projects that they are holding, and as long as we see any improvement in the execution of the critical projects that each of these asset owners are having, we will not invest into that. So I think industrials fine, but infra and asset owners, we will restrict our commitment right now to basically public sector companies, essentially because of the environment. The monitorable will be definitely interest rates and the execution of the critical projects that some of these asset owners will have.
Right, Dhirendra, really appreciate your time, and thank you for your wonderful insights.